Welcome to Minimus Maximus. I'm Daniel. A friend of mine asked me about the all-weather portfolio, and so I decided to make a video about it, and hopefully you guys found it useful. Let's start with this book so he give us some background. The Global Asset Allocation by Meb Faber. He runs the Cambria Investments. He runs also this podcast, the Meb Faber Show, and I recommend it. I actually learn more in this podcast than studying finance, probably. It's kind of ironic. Anyways, so in this book, he went and tested the legends of finance and their portfolios, what they recommended. So it goes from 1972 to 2013. And he did Ilarion, he's from PIMCO, Buffett, Mark Faber, the guy from like emerging markets, 60/40 is the risk parity, Rob Arnault is the factor-based models, All Seasons, the Ray Dalio, the All-Weather, and the permanent portfolio. So what he found out with this is that what matters is not so much the strategy. You can get the best strategy becomes the worst strategy because of the fees. So fees are the most important thing, and probably already know that. It's kind of common sense, but we'll elaborate a little bit more on that. So let's go back here and look at some points I wanted to talk. So the first one is don't chase stock picks, build a robust portfolio. So what I mean by that is that if you start looking at, CNBC and, all those blogs and different YouTubers and whatnot, you're going to start buying this thing, and then you know when to sell it, when to buy, maybe you overpaid, and then what to do with it, and at the end you end up losing money. So that's a really bad strategy. You'll see a lot of millennials like jumping into airline stocks, and maybe that works, but in the long run you're probably going to run out of luck, and then you're going to end up losing the money you made the first years. So building a robust portfolio is the way to go. You want to get to the end, like in 30, 40 years, you want to make sure you accumulate a lot of money. The second point is start by protecting capital. So instead of focusing on making a lot of money, like what's the stock, what's the hot thing to buy, focus on how do I don't lose money. If you cover the downside, the rest is a gain, I promise. The third point is dealing with uncertainty. So finance has a lot more to do with philosophy than finance itself. What I mean by that is that the future. Nobody knows. Even the pros or the legends don't know anything about the future. So you may get lucky, but it's just a very hard game. And so that's what is going to bring us to the all-weather portfolio, because it works well in different regimes, and that's ultimately what this video is about. Finance legends also lose money. So I have this book, The Intelligent Investor by Benjamin Graham. And he lost money in the 1929 crash. And he's like the god of finance. So the value investing route is just so hard because you have these crazy drawdowns. You have this like 25%, 30% drawdowns. So you're going to lose money at some point, and it's just really hard psychologically. The other thing is that regimes change, and you're going to have periods of times where stocks do well. Sometimes they don't do so well. And furthermore, he focuses on fundamentals, and these days, because of all the money printing, and it's a market that is very artificial. That took some while. It's a market that is artificial, and it's just very tough to use valuation. Valuation doesn't even matter anymore because you have stocks going like 30, 40 Ps, and you don't get anywhere. Okay, anyways, let me show you this chart of, here's a bigger version of it. In this chart, you see that this is the Dow Jones from 1896 to 2016. And you'll notice that if you bought stocks in 1930, it would have taken you 25 years to recover your money. So I bet you 3 years down the road, you would have capitulated and you would have sold, and you probably never invested again. So just buying stocks is just it's just hard, okay? Like, it's better to have different asset classes, and what you want to have is, uncorrelated bets. So a lot of YouTubers and even in school, I remember they were telling us, you should buy, 50 stocks, 100 stocks. And I remember after 20 stocks, the whole diversification effect loses its power. So there's really no need to have so much. So the best thing is to have uncorrelated bets. You want to have some bonds, you want to have some gold, you want to have some commodities, and that way your volatility is going to decrease and your performance will improve. So before we move in, I just want to mention that I read this book by Ray Dalio, The Big Debt Crisis, and you have to learn about cycles. And in this book, you realize how hard it is to deal with volatility. There are periods where there's so much volatility that it's so tough to get the right stock, the right asset class. So it's just difficult. Sometimes you'll have a period where you think you're buying the dip, and then you end up in a regime where it's a really, really bad, and then you buy more, and then you end up even losing 50, 60%. And you should also know when you lose 50%, you need to go up 100% to recover your money. So the point of this strategy is that you need all those drawdowns. The last point I want to make is that you have some YouTubers talking about dividend portfolios, and they're nice, but same problem. You're going to lose 20, 30, 40% on your portfolio, and they're probably going to cut the dividends, and they also, legislation can change. Maybe, they cannot issue dividends, who knows. So it's very hard psychologically. So for me, I hate losing money. So I think this is the strategy that worked for me. My uncle, he's mostly in real estate, but he wanted to invest some money. What happened was that he had his money in mutual funds. It was like a mutual fund salad, all kinds of stuff. It was ridiculous. And he was paying about 3% in fees, which is a lot. You can buy the whole U.S. stocks and ETF is 0.04 basis points, I think. So you can build a nice global portfolio for 10 basis points probably. So you need to pay the 3%. That's a lot, very expensive. So you don't want to do that. So here, this is basically the all-weather portfolio that we'll touch a little bit more on this, and I'll explain this sheet. So, okay, this explain what the all-weather portfolio is. So Ray Dalio, when he started history, he realized that asset prices change according to the productivity and the inflation. That's the main factors that drive everything in the economy. So you have periods where you have productivity growing and inflation growing, and that's one regime. So for example, if you have growth slowing and inflation slowing as well, then treasuries and gold will do well. And for example, who knows, because all that money printing, maybe we'll get in a regime where, they have to devalue the dollar, or it already feels like the dollar is falling. So commodities probably will do well, and tips, inflation protected bonds, and gold. So the thing is that you want to have an all-weather portfolio because you know which regime is going to happen in the future, and as long as you have a little bit of everything, you'll make money, or at least you lose less than everyone else. So let's look at this portfolio visualizer. It's a great tool for you to test portfolios. And by the way, you don't have to have the exact same all-weather portfolio as Dalio. You can have variations, something that you feel more comfortable. Maybe you feel like, I want to have a little bit more gold and a little bit more commodities and not so much bonds. You could totally do that. As long as you have a little bit of everything, you should be fine. Just remember that bonds are less volatile. That's why you need a lot more of those. And stocks are a lot more volatile. So you need more of those. And same with commodities. That's why the allocation is only 7.5% because they're so volatile. So let's do a back test from 1985. It's probably not going to work that far. It's going to go from 2010 because some of the ETFs didn't even exist. And so these are the symbols. TLT is the 20-year bond. The VGIT is the intermediate bonds, like, what is that, 10 years probably. So allocation, 40 plus 15, 55% in bonds. Gold GLD ETF, 7.5. DBC, 7.5. VTI, which is the total stock market, 30%. And that's 100%. And then here, this is the Tony Robbins Money Master the Game allocation. So you have 40% bonds, 15, and intermediate. This is long term. This is gold is 7.5, same DBC, and then the stocks is VV is large cap, so 18% because it's less volatile. VV is the small cap, so it's a lot more volatile, so you want to have a smaller allocation. VWO is emerging market, so very volatile, so you want to have a small allocation. VEA is 6%, so that's 100%. And what happens? So you hit analyze, and what happened here? So portfolio one had 8.25. These are nominal returns, not real. 7.49 for the one more global. But as you can see, it's not as volatile. It's only, 5.61, 5.70. And this is if you only bought stocks in the US, you would have made 12.38%. But then your volatility will almost double. And this is how much money you would have seen your account going down. So if you had the all-weather portfolio, you would have lost 6.69%. With the more global is 7.44 because you have small cap and emerging markets. And here you would have seen your account going down 19%. So here you see how like super volatile because you only have stocks, and you see this is the 2020 crash. So I don't know, maybe you would have sold or get in panic, but if you just had the all-weather portfolio, everything is so smooth, you actually didn't even lose money. You actually make some money. So this is my uncle's. So he's in Europe, so they just disregard this ETFs because these are for Europe. But we build this at 4/10 2019, and we were supposed to balance in 4/10 2020. We balanced, I think, on June, and then we did a little twist that's more similar to the permanent portfolio. We decided to have more gold, but it's pretty much no weather, Like I said, you don't have to strictly follow it. And what you notice here is that what happened was that the bonds did really good. The long-term bonds went up 44.86% since then, and 29.40% return on gold. Commodities is horrible. U.S. stocks did okay, although most people are heavily invested here. And then emerging markets went nowhere. And so, like he made 6% this year, not amazing, but while everyone else lost money, he actually made money. So if you backtest this from 2020, let's see how it performed in that crazy crash, because this year is great to test. Let's see. Okay, so the total stock market from US, you would have lost 3%. You'll be down by now. You will be up 8.47 with the easy peasy all-weather, and with the global one 7.76, and your account would have only fall 1.52%. So I remember when things crashed, I didn't even feel it. I was like, the bonds just went to the roof, and it was actually cool. But then I got nervous because there was a time where bond volatility went up a lot, and actually bonds sold off too, because when you have like a liquidity event, people sell even the things that they're doing well, like gold even went up, because the gold volatility, there was a point that it went up so much that people started to getting rid of gold, and it was a little bit scary. But even though that happened, the portfolio during that month didn't go down so much. So the all-weather portfolio really helps you with volatility. It really helps you stick to your process. I will mention something later. I don't know if I want to skip. Okay, so we covered this. We covered how to build it. And now since I'm already talking about it, I want to mention it. So there's one thing that I'm a little bit concerned, and that's the heavy bond allocation. So the problem is that things that did well in the past usually don't do well in the future, because you already ate the returns, you already enjoy the gains. So usually nothing, goes up forever. So because bonds did so well, and I think the 10-year yield today was around, in the morning was 0.70. I don't know right now. It's very close to zero. So there's just not much to cut already. So we're probably going to go maybe, I don't know, to negative interest rates. Who knows? Japan's already there. Europe is already there. So bonds, they start to behave like cash, and they don't, they lose its protective power. The other thing is about bonds is that, people are like, how do you make 40, 50% with bonds if the yield is so small? Well, the reason is when they cut interest rates, let's say if you have a rate of change from 1% to 0, that's 100% rate of change. So that's a huge move. And so you have, when they cut interest rates 1%, because you have the long end of the curve, because it's a 30-year bond or 25, 20 plus, then you have huge capital gains, but in the long term, it's probably not so good because you already enjoy the gains. That's what I'm saying. So having said that, maybe this is just how I think about it. This is not investing advice. You have to do your own research. Don't listen to anybody. Listen to yourself and listen to the gurus. Read the books and, use this software and figure out what works for you. But I like this strategy. So let's say you want to do 20%. This is the permanent portfolio, which is 25% long-term bonds, 25% short-term bonds, which is cash, 25% stocks, 25% gold. So this is the VTI. We'll do 20. We're just gonna mess with it a little bit. This is 25 cash, so you have some gunpowder to buy some other opportunities, And then what I would like to do is, instead of having only stocks, I want to add some what was that stock? The GDX, I think. GDX is the gold miners. Yeah. Because I think gold is going to do so well because of all this crazy money printing and artificial market. So instead of having 25, I'll have 5%. I'll have 5% Bitcoin. This is just me, okay? And then what else am I missing? And then I'm missing bonds, stocks, and then gold. So gold 25. So gold is the currency, so it withstands more volatility. These are gold miners, so they behave like equities. So that's why I put them under VTI, which is the stock market, okay? Because that's how I think about it. And so if you did that, then portfolio 3 would have, crushed it. Like you would have 11.32%. your drawdown would have been 3.83%. You know, so not so bad. Volatility would have, you know, be similar to actually half of like the only stocks, like better, but still your gains will be better. So going forward, I think having a little bit of Bitcoin and gold miners will help offset the fact that bonds are very close to zero interest rate. So that's just how I look at it. That's how I'm, you know, doing it. And that's what I'm going to do. I'm not saying you should do it the same way, but I think it's a good way of doing it. The other thing I want to mention is like, if you want to be crazy and there's a stock you like or an idea you like, you want to buy options or be crazy, do it. But maybe only invest 2% of all your money. So be crazy with 5% maximum. 95% is your all-weather portfolio. In case you make a mistake, you at least have something left. That's the last thing I will mention. So I have this spreadsheet. If you guys are interested, this is something I build. You can, it follows Google Finance. So it has, I build this because obviously I cannot access my uncle's account because, you know, it's private. But I build it so I can kind of follow what's going on with this investment. Maybe there is an emergency or something. I can call him and just kind of like have a second look on it. And yeah, I'll be happy to share it. I also put the Robinhood link if you guys want to use it. I'm not super crazy about it, but if I recommend better like Tiramiri Trade or something. But if you want to use Robinhood, it's fine. But you know, I'm just not too crazy about it. And then lastly, when you buy all these ETFs and stocks, always use limit price. And the reason why is because when you use market price, when you buy the stock, this hedge funds that place your orders through Robinhood, they will front run you and they will make money of you because they know how much you're paying. So they give you a worse price. So always use limit, okay? And that's it, guys. I'll see you in the next video.